as key decisions reached at the 259th meeting of the Monetary Policy Committee of the Central Bank of Nigeria continue to elicit reactions from operators and stakeholders in the economy. Many see the committee's retention of the monetary rates as a realistic approach to the economic recovery process. Olazerni Doroja reports. In line with expectations in many quarters, the Monetary Policy Committee of the Central Bank of Nigeria penultimate Tuesday left the benchmark interest rate, the monetary policy rate, and other key monetary indicators unchanged. At its 259th meeting in Abuja, the monetary regulator retained MPR at 14%, cash reserves ratio at 22.5%, liquidity ratio at 30%, and the asymmetric window at plus 200 and minus 500 basis points around the MPR. Reaction expectedly, the MPC decision has elicited mixed reactions among stakeholders. Some analysts are not altogether surprised at the decision, having predicted it would go that way. Many feel the economic situation in the country, within the context of global economic developments, require a hold back to strengthen the confidence-building process. Indeed, from the Q3 2017 Gross Domestic Product report released early last week, the aggregate growth in the economy was induced by the improved performance of the oil and gas sector. Agriculture also made significant contribution, but other critical sectors, including construction, telecommunications, trade, and real estate, continued to lag. The banking and insurance industries did not fare any better. According to a banker with a third-generation bank, "I don't blame the CBN for its decisions. In addition to the contribution by the oil and gas sector, is the multiplier effect of the exchange rate stability and the rate convergence that we have seen at the NAFEX and parallel market. The huge foreign capital inflow witnessed since Q2 2017 to date is attributable to the exchange rate stability. This inflow contributes significantly to the overall growth of the economy. But many operators in the real sector, who had for months hoped for a downward review of the MPR, have had their hopes dashed again. The real sector operators say they need the MPR reduction to ease access to capital and boost manufacturing." President of the Manufacturers Association of Nigeria, Drive. Frank Jacobs, captured the frustrations and disappointment of operators in the sector in an interview with THISDAY, where he expressed his displeasure at the retained rates. Going into the meeting, which is the last for the year, the MPC was under pressure to reduce the benchmark lending rate, MPR. Decisions Chairman of the MPC, CBN Governor Godwin Emefiele, explained, in arriving at its decision, the committee appraised potential policy options in terms of the balance of risks. The committee also took note of the gains made so far as a result of its earlier decisions, including the stability in the foreign exchange market and the moderate reduction in inflation, and, thus, extensively deliberated the options regarding whether to hold, tighten, or ease the policy stance. While tightening would strengthen the impact of monetary policy on inflation with complementary effects on capital inflows and exchange rate stability, it nevertheless could also potentially dampen the positive outlook for growth and financial stability.